Please see the full disclaimer on your screen before we begin.
In commercial real estate, the landscape is built on unforgiving classifications. We sort properties into Class A, B, or C based on quality. This rigid sorting applies to people, too. We rank operators strictly by portfolio size and total assets under management. At the absolute peak of this hierarchy sit the institutional tycoons, controlling elite properties draped in imported stone and classical art. These spreadsheets and corporate entities create a powerful illusion. They make the portfolios look completely invulnerable, masking the living, breathing human beings who actually bear the risk. Right now, the market is cracking under immense structural pressure. High refinancing hurdles and erratic macroeconomic volatility are pushing stress levels to historic highs. This chart shows a rapid decline in asset equity across the sector, heavily obscured by standard underwriting jargon. When crises hit, we tend to measure the collateral damage entirely through these cold metrics: foreclosure rates and non-performing loans. Wealth and massive institutional backing might buy better lawyers, but they offer zero insulation from the physical realities of stress, aging, and market collapse. Looking at the market solely through a financial lens leaves you blind to the real, unquantifiable risks behind every transaction. High-stakes investing carries a human toll, and no limited liability clause can protect against it. Imagine erasing the financial grid entirely. If we strip away the corporate entities and net worths, we can group all investors by universal, brutal equalizers. The first class is defined by sorrows: the grief of a ruined legacy, the sting of public failure, and the weight of letting down your family taste exactly the same whether you lose a $2 million asset or a $200 million empire. The generational developer whose family name is etched into a massive suburban office park suddenly shares the same bench as the small-time operator losing their first 20-unit building to foreclosure. The second class is defined by maladies. The commercial real estate grind demands a constant, unrelenting psychological tolerance for risk. The executive pacing a luxury penthouse over a looming $50 million debt maturity belongs in the same group as the landlord lying awake on a modest mattress, terrified of a tenant lawsuit. Both suffer from the exact same ulcer-inducing anxiety, elevated blood pressure, and chronic dread. When a human body begins to break down, it does not care about your internal rate of return. Biological failure renders financial class completely meaningless. The final, hidden class is defined by sins. The market publicly celebrates financial winners and aggressively punishes losers, but it rarely takes a hard look at the soul of the operator. In this category, all public prestige vanishes. The disgraced operator sitting in a federal facility for running a Ponzi scheme sits right next to the highly respected suit-and-tie institutional investor. They are united by the same ethical compromises: quietly fudging occupancy numbers, burying an environmental hazard, prioritizing yield over human dignity just to force a deal across the finish line. A strict pragmatist would argue that none of this matters in a boardroom. In the cold eyes of a lender, a distressed property isn't rescued by human empathy. It requires hard liquidity, capital reserves, and precise underwriting to survive. Hard liquidity might save a specific asset from foreclosure for a few quarters, but the sheer act of deception permanently erases the rigid boundary between the elite tycoon and the common criminal. We use heavy institutional language like fee simple absolute to describe property ownership. It implies a permanent, unbreakable grip on a piece of the earth. But no matter how tightly a contract is drafted, time and mortality remain the ultimate, unnegotiable counterparties in every single transaction ever signed. Even the most monumental, globally recognized empires of real estate are intensely vulnerable when subjected to the passing of time. No matter how large a portfolio grows, no one actually owns anything permanently. Every investor is a temporary tenant, managing temporary structures, built on temporary dirt, destined to be swept through the exact same portal of mortality. This philosophical reality becomes glaringly obvious when executing complex adaptive reuse projects. On paper, they look like cold underwriting exercises, but they are actually direct responses to a fractured social infrastructure. The end point of these conversions is often transforming outdated hospitality assets, like this humble single-story motel structure, into crucial, affordable workforce housing. The luxury hotelier struggling to meet a sudden capital call, and the workforce tenant desperately searching for a safe place to live, are navigating the exact same turbulent macroeconomic currents. Real estate is a distinctly human business. The structures we reposition are only as valuable as the lives they impact. If an investor loses sight of that shared human baseline, they aren't building a legacy at all. They are just shifting temporary dirt.